Well, the S&P 500 is still on track for its fourth straight weekly loss in a row. Now, that would be the longest losing streak in almost a year. And this comes as investors do stay cautious following this week's massive surge in volatility. Here to discuss, we want to bring in Ed Yardeni. He's the president of Yardeni Research. Ed, it's great to see you again. So we last spoke on Monday morning when it looked like things were falling apart. Yet you told us at that time, you said, don't panic. The unwind should, quote, be over by the end of the week. So here we are at the end of the week. It looks like you were right, but what should investors now be anticipating that we'll see?
Well, yeah, my point at the beginning of the week was that it's too late to panic, that much of what we saw was a short covering situation vis-a-vis the yen, the so-called carry trade, where traders had borrowed a lot of money at zero interest rates in Japan, and then converted that either into other currencies and bought something like maybe the Magnificent Seven. And so all that trade kind of cratered, and the Bank of Japan came in pretty rapidly and said, you know what, we're going to not be raising rates here as aggressively as we had signaled. And so that calmed everything down. A lot of this was centered in Japan. Looking ahead here, I think we're going to see the market continue to churn below the July 16th high. So I think that the churn will probably continue through September, October, until the November elections. So I expect the market to kind of go sideways with a lot of volatility below that July 16th high. And then I think we could very well have a year-end rally, a Santa Claus rally, as people become more confident that the economy is resilient and it might do well no matter who's in the White House.
Ed, a churn lower, even if we do see a 25 or 50 basis point rate cut, which would initiate the beginning of the cutting cycle?
Mm-hmm. Well, look, I think when we were in the midst of that panic on Friday of last week and Monday of this week, there was some people calling for an emergency rate cut, some as much as 75 basis points, others saying that, well, you know, instead of 25 basis points in September, the Fed should do 50 basis points. All that, by the way, would have exacerbated the carry trade unwind because it would have actually strengthened the yen and weakened the dollar, which is a major cause of the unwind. So I'm glad that a lot of that hysteria is probably behind us. And why is that? Well, the data, the latest batch of data we've had has been pretty good. The purchasing managers for non-manufacturing was pretty good. Initial claims was good. The economy's doing fine. So I don't think that, believe it or not, I don't think the economy needs a rate cut at all. But you know, I bow to the will of the Fed, and they I think will deliver 25, not 50 in September.
And I guess my question is, when you take a look at the market's reaction, especially to jobless claims yesterday, you had this big rally, the S&P having the best day that we've seen since 2022. And this all comes while the market is still pricing in larger than usual rate cuts here for September and for the remainder of the year. It doesn't seem like both of those positions can be correct. Can they? Am I missing something?
Well, I think you're right. It's either or. Either the economy is weak and the Fed's going to have to deliver more rate cuts. And then there is this notion that, you know, sometimes you get the market going down when the Fed first starts cutting rates. But a lot of that has to do with the history of the credit cycle. In the past, the Fed started lowering interest rates in response to a credit crisis. This time around, so far, we haven't really had a credit crisis. We had one last year, but the Fed dealt with it really pretty rapidly. So I'm thinking that, you know, in terms of, we have two choices here. Either the economy is better than expected and we get only 25 basis points, or the economy is worse than expected and we get 50 basis points. I picked door number one. I think the economy is fine.
Ed, when we were speaking with a few money managers and strategists over the course of this week, there was the anticipation and then the action that they were noticing of some investors to still say, okay, we're going to open some new positions because we did see attractive, or relative to a few weeks back, attractive levels for some very highly valued stocks. Where do you think we'll continue to see that if there is more slippage?
Well, I think that we did start to see the market broaden before the carry trade unwind, and I think it'll resume that broadening. That probably means that the Magnificent Seven, yeah, when you get a drop in them, it's probably something worth considering buying them. But I think they may just take a pause here, and the market will resume its broadening into the S&P 400 and 93. And we could also see some broadening into the SMID caps, the small and mid cap stocks.
And how volatile do you think the market's action is likely going to be? Just judging off of what we saw yesterday, when we look ahead to the CPI print that's coming in, and looking even further ahead to that next jobs print, all coming before the next Fed meeting. Is this something, maybe not to the degree as to what we saw yesterday, given a lot of that was from the bounce back from Monday, but is that something that's going to become this new norm?
It may very well. I mean, it was only a week or two ago where people were observing that the VIX was extremely low, that there wasn't much volatility. The market just was going up day after day. It was a long time since we had a 1% or 2% sell-off, and well, here it is. So these things do kind of cycle, and we could, like I said, I think between now and the elections, I see churning. So churning is volatility.
Ed, great to speak with you again. Thanks for bookending our coverage here over the course of this week. We really appreciate it. Ed Yardeni, who's the Yardeni Research President.